Welcome to Texas Insurance Training Academy. This is Property and Casualty General Lines Initial License Training. Before we get started here, I just want to kind of go over the basics here. We have the first half, which we usually do in the first day, is going to be focused on personal lines, and then we get into commercial lines on the second day. So with that in mind, we will proceed over to the overall process before getting into the details here. The overall process is different for everybody, and it mostly depends on how you go through what we call step 0, which is preparing for the exam. The classroom and or the online accompaniment here is going to be the main base for you, along with our textbook. And then we have an online accompaniment through exampreptx.com, which is a different website than our texasinsurancetrainingacademy.com. Once you're prepared for the exam, which is going to be a little bit different for everyone, then you're going to go through 3 steps to get your actual license. The first step is to go through a company called Pearson VUE, where you're going to schedule and hopefully pass the examination. Pearson VUE's website has a lot of features in there. You are required to take this in the state of Texas in person. And you can find locations on the Pearson VUE website where to take this. We teach our class to the General Lines Property and Casualty Licensing, which is going to be INSTX-PC06. Don't really recommend taking it in Spanish, even if you're fluent in Spanish. Unfortunately, this is going to be one of those things that is going to be a lot more difficult because they use Castilian Spanish instead of standard Spanish that most people speak. Once you have been successful with step 1, you will move on to step 2, which is to initiate a background check with the state of Texas. The only reason you wouldn't need to do step 2 is if you were already licensed with the Department of Insurance. So if you've done a background check with the state of Texas previously, unfortunately, that will not help you in this regard. So you will have to go through a company called Identico, and they have a special code for initiating the background check, which is basically done by getting a set of digital fingerprints verifying your identity, but registering online with the code 11G6QF. Once you've got that completed, those first 2 steps, then you will be allowed to apply for your license in step 3, which is going to be through a company called Circon. And when you go through Circon, you're going to be able to access all of these links on our direct website, texasinsurancetrainingacademy.com. And your general lines will be the first thing you select, and then it's going to be property and casualty from there for the general lines. So that's the 3-step process in order to get your initial license and get your license with general lines, property and casualty. A few test taking tips and skills to kind of get out of the way. The best tip that I can give anyone for any test, but especially for the test through this Texas state exam, is that you got to make sure that you fully read the answer in total before you read any of the answers. You got to fully understand it, because they like to use specific words where they're going to change the meaning. The most common one is going to be all the following except, but they'll throw in things like always, never, not, every. And what happens when these words get used is that they change the meaning of the question. So it's extremely important that you actually understand what the question's asking. One of the things that we typically do in here is to phrase specific things that are going to be needed here, so that it makes sense. So we'll work on that as a technique for you going forward. Understand that the standard for the state exam is going to be that there is possibly more than one correct answer, but the test is based on the best possible answer. So probably a couple of times per overall test that will come up where that's the case. And just so you know, basically the examination is going to be a 2.5 hour period of time for you to take it. Everything that we have here is to try and get you set up for that entire process. Basically, there's 150 questions, 150 minutes, so about 60 seconds per question. There's a limited amount of math on there, but the passing score for the examination is 70%. Our goal for you and to meet our guarantee is to be at the 70% passing mark. For the state exam is to get you at 80% or higher on our online accompaniment exampreptx.com. This will be directly linked in the email that you got signed up with, or if you did an online only, this will be available through there as well. Just understand that the majority of this test is going to be memorizations of terms and definitions as you know, the specific types of policies. We'll use this information later on within those test questions. So you will be provided all the things necessary for the exam, usually a piece of paper laminated that you can use a dry erase marker on, or a calculator for any of the math type problems. So now that we've kind of gotten that out of the way, I'd like to get into the beginning of the material here, which starts out with chapter 2. We come back and do chapter 1 at the end of day 2, just to kind of make sure that we are going over the basics of everything. Chapter 1 is Texas statutes, and it's backwards in the book versus the way that it's taught on the test. There's section 1, which is going to be chapters 2 through 16. And then once you've submitted section 1 on the state exam, you'll submit section 2, which is going to be just specifically on the Texas statutes. So we'll wrap up the end of the training with that specifically. And in Exam Prep TX, we're going in the order here of how we test this out. So the first section is going to be here on insurance terms for chapter 2. On the chapters 3 and 4 under provisions in contract law, then chapters 5 through 7 property policies, dwelling homeowners, and then chapters 8 and 9 under the 4th section. This is going to be personal auto policies and umbrella and excess liability policies, as well as residual markets. Those are going to be everything that we go through traditionally on the first day of instruction in classroom. On day 2, we start out with chapter 10 through 12, which is going to be commercial property policies, business owner policies, and inland marine policies. And then on chapter 13 and 14, that's going to be our commercial general liability and commercial auto, chapters 13 and 14. And then crime insurance under chapter 15, and bonds under chapter 16, with also the workers' compensation in chapter 16. And then again, we wrap up with Texas statutes chapter 1. So beginning here with chapter 2, insurance terms and definitions, understand that this is a lot of memorization here, but it is applied to all the other sections. So the way that these chapters go is that they kind of build upon each other. You may want to make sure that you've got a strong base here in the early chapters to make sure that you're going to be okay for everything going forward. So starting off with chapter 2, first thing, it's important to kind of define the different parties to insurance, because everything in insurance is a little bit different because it is designed to be legal. You've got lawyers and accountants who created insurance, and the whole reason that people get insurance in the first place is because somebody doesn't want to pay a big bill, and they want to pay a small bill instead of having to pay on a regular basis, instead of having to pay a big bill whenever it may just happen. And that's really all insurance is. So there are different parties that are to the contract and to insurance. And the first party is going to be the person that wants to not pay that big bill, right? So this is called the first party. Typically, this is associated with the applicant or the insured. The second party, this is going to be the insurer, also known as the insurance company. This is also going to include the agent because they're going to be contracted through express authority to work on behalf of the insurance company. So who you represent as an insurance agent is really the insurance company, and you would be part of the second party class of any legal definition of the parties to insurance. The entirety of liability is going to be third party. Sometimes this will come in on ownership of policies. If the person that's insured and the person that is paying for the policy are different people, that would be an example of third party ownership. But for the most part, anybody else that gets paid out in insurance, which would typically be liability insurance, which is another name for casualty, would just be anybody else that is not part of the first or the second party contract. Insurance. This is going to be defined as the transfer of risk of a financial loss from the first party to the second party. Risk is defined as the uncertainty or chance of a loss occurring. There are two types of risk, insurable and non-insurable. The insurable type is pure risk. In this case, you can only have the chance for a potential for a loss or no gain happening. Speculative risk, which is tantamount to gambling, there is a possibility of a gain. And therefore, because of this, the speculative risk is generally not insurable. The insurance companies, the way that this entire industry works is that they take a large group of people that have similar exposures to loss that they have a lot of data on, which makes it more predictable that those losses will be able to do so that they can potentially get a profit. So this is called a concept called the law of large numbers. And basically, in this situation, the company that has the largest number of people should, in theory, have the most predictable loss ratio available to them. Now, one thing that we always do is we go along with some of the questions in the book here, even through the presentation here. And so question 1 on page 31 is which company has the best chance of accurately predicting losses or of making a profit? The answers are the newest company, A, B, the oldest company, C, the one with the most customers, or D, Texas Lloyd's. Now, typically, I would allow for a classroom to answer this, but since I'm doing this on a recording here, the answer here is going to be C, the one with the most customers. And that makes sense because they are employing the use of the law of large numbers. Concept in property casualty and other insurances is insurable interest. In the property casualty space, the insurable interest is required to be existing at the time of the loss. Parties that may have the insurable interest in a property would be owners, lessors, or persons with work not paid. Now, depending on which part of the country you're from, depends on how you might pronounce this next word, peril or pearl. It means a cause of loss, right? So example of a peril would be a lightning bolt or a fire or a collision in a car wreck. So these are what we call perils. Now, they can either be named or they can be open. Now, named perils are specific causes of loss that are listed on the policy. So they will be specifically delineated on the policy, and that policy either will have it covered, or if it's not listed, it will not be covered. Under open perils, everything is going to be covered except for those things that are specifically excluded from the policy, right? This is going to be a more expensive option because generally most things are going to be covered, and then we'll talk about the exclusions a little bit later. Hazards. Now, this is a condition that increases the probability of the loss occurring. So an example here would be, 3 different types of hazards, right? We've got physical things that you could see, feel, smell, hear. An example of physical hazard would be a wet floor. A moral hazard, this is something that arises from someone's bad character, right? Somebody that wanted to commit arson or fraud. would be an example of a moral hazard. And then the last type of hazard is a morale hazard. This can be summed up with the phrase, it's just a rental, right? Indifference to the loss due to the existence of insurance, right? Have you noticed somebody treat something a little bit differently when they consider it to be not theirs, right? Oh, it's just a rental, right? I don't care about that big speed bump, right? I'm just going to go ahead and take the rental car over that speed bump and not really care about it like it's my own car, right? So that's what we call morale hazard. Now, one example that we're going to see here in property insurance about these named and open perils, the example we'd like to give is at the bottom of page 31 here. Damage caused by wild animals is usually not excluded in open perils, but it is usually not listed as a named peril. So if a property has open perils on the dwelling and named perils on the personal property, the incurred damage caused by a wild animal, the structure would be covered, but the damage to the personal property would not be. And this is very typical of most homeowners policies, in fact, because the most common one is an HO3 policy, which is exactly set up to be this way. And we'll get into that a little bit later. What is a loss? A loss is defined as a reduction, decrease, injury, or amount paid or disappearance of value of either person or property. And there's two different types of losses. There's direct losses and indirect losses. Direct losses are those physical losses due to damage of property or a person. And then the indirect losses are going to be consequential or time element losses. In order for an indirect loss to be payable, there first has to be some type of direct loss covered before the indirect loss could be paid out. The concept of proximate cause. The proximate cause is the first or immediate cause in an unbroken chain of events. If it hadn't occurred, then that would not have happened. It's important to determine when there is a claim, because if the proximate cause is going to be covered, then the remaining and subsequent losses they're going to also be covered. So a concept of this is you cause an accident with your car on a highway. The following car then collides with you, then another. And since you were the first cause of the chain reaction of a multi-car pileup here, you're the proximate cause, and all the damage would therefore then be your responsibility, right? There was an example of this happening over on 35W outside of Fort Worth around 15 years ago. It was a winter situation, but that doesn't really kind of come into play here. What happened was a commercial truck had swerved a little bit too much, hit the inside barrier, and then jackknifed across the lanes. And what happened was, in the end, 37 different cars piled up. And unfortunately, that company did not have enough insurance to cover all the liability for the property damage to 37 vehicles, as well as the bodily injury that occurred in that accident case. So therefore, because there wasn't enough insurance to cover it, then the company was still liable for it. They ended up going out of business because of this. All right, so the principle of indemnity, right? Indemnity is also known as reimbursement, indemnification, indemnifying, restoring, or making whole, right? So the principle of indemnity is important with property insurance because you can only collect to the extent of the loss, and you're not supposed to be able to financially gain or profit from the loss, right? So this is what the principle of indemnity is. So the example we give here on page 33 is John has a policy insuring his home after his air conditioner was damaged in a fire. His expense to replace the unit was $10,000, but he also found that he had coverage for the loss on a warranty policy for $1,000. He cannot collect the additional $1,000, as that would give him the profit of $1,000 and would violate the principle of indemnity. Also, typically, you would see this specifically excluded in the policy so that it wouldn't be able to be completed. An accident is defined as a sudden and unexpected event causing injury or damage that is either neither expected nor intended. An occurrence is a broader definition. It includes all the accidents, but it also includes events caused by those losses occurring due to continuous or repeated exposures. And on the state exam, you're going to see a specific detail of continuous and repeated exposures if they are having both an option for accident and occurrence on the same question. Property policies in general will insure tangible and intangible, right? Those things like electronic data would be intangible property and typically are excluded from most insurances. You would be able to cover them, but we will talk about that a little bit more specifically tomorrow with inland marine. Liability policies, these are going to insure the first party's legal liability to third parties, right? So typically the liability policy, you want to remember, is going to pay out to the third party, but it's going to protect the first party, okay? Bodily injury and property damage, these are concepts under liability, right? So bodily injury, sickness or disease sustained by a person up to and including death would be the definition for bodily injury. And then for property damage, this would be any physical injury to tangible property plus its loss of use, right? And they do remind you here that electronic data is not tangible property. One thing that we will go over a little bit more detail when we get into automobile insurance, but we bring up now, is the per occurrence combined single limit, or CSL. This is a sublimit in a liability policy that puts a ceiling on the payment of all claims arising from a single accident or occurrence, regardless of the number of people injured under BI, bodily injury, or properties damaged under PD, property damage. Per person limit, this is going to be the maximum amount available for payment of bodily injury to a single person in an accident, regardless of the total policy limit stated for bodily injury claims. Now, in this case, multiple people can be paid out until the aggregate limits have been exhausted on that policy. Negligence. This is defined as the failure to use care that a reasonable and prudent person would have taken under the same or similar circumstances. So for elements to negligence to occur, you have to have all of these or there is no negligence. The biggest one on the test is going to be an actual loss occurring, but there is always going to be either a legal duty owed, either to act or to not act. There has to be a breach of that duty, and then that breach has to be the approximate cause. So the example we give here is that bars have a legal duty to prevent the intoxicated person from leaving to drive themselves home. The intoxicated customer left the bar before they could be stopped and then weaved their way home and went to bed. Did the bar in this case have negligence? Well, the answer is no, but the reason it's no is because there was no actual loss. There was a lot of risk that was taken on by the bar. However, in this case, because there was no loss, there is no negligence. Now, the state likes to ask several questions about liability. We're going to talk about the types of liability here, right? So liability policies are going to pay on behalf of, and they're going to have a duty to defend the insured's negligence, right, for the first party, even if the claim is false or fraudulent. Understand that it is not required for the court to prove negligence. The insured can admit it, or the insurance company could find you at fault, right? So in those cases, you will have the liability being determined by somebody other than a court. Now, these different types of liability, like I said, are going to be required to know for the test because the state likes to ask a lot of questions about them. Direct liability is the first one we're going over, right? So this is imposed to an insured, the first party, by law for the first party's negligence. Now, understand that one of the things that they ask a lot of here is that owned animals actually end up being direct liability. And so in this case, if your dog bit a neighbor or the mailman or something like that, you would be directly liable for the damages to that person, okay? Now, absolute liability, this is similar to direct, but it's imposed to an insured by law. However, negligence does not apply. The most common examples you're going to see here are what we call attractive nuisances, things like swimming pools, trampolines, or sand piles at a work site. These things tend to attract people, and unfortunately, even though you may put a lot of barriers in place, if somebody, some small child was able to get around your fence and the alarm and everything, gets into your pool and drowns, unfortunately, you are going to be absolutely liable for that kid's drowning. Okay? Same thing for trampolines, sand piles, pretty much anything that they're on your property. But these things typically are things that are going to be a little bit more likely to have that liability there because of what we call an attractive nuisance. If you're any kind of manufacturer or you make any products, you could be subject to what we call strict liability. So the insured product is supposed to have what we call an implied warranty to be safe, right? So when you use a product, you're not supposed to get injured, right? So if you had a fork that for some reason kept stabbing you every time you were using it properly, that would be something that the manufacturer of the fork would be responsible for. Now, for example, let's just say you've got a chair. Well, if you're sitting in the chair and the chair collapses, and there was a certain weight rating on there and you're fine with that, then the product fails, then you may have a case against the manufacturer. However, the manufacturer can rebut that if you were using it in a manner that it wasn't intended. So if you got up and climbed on top of a chair to, say, get to a ceiling panel or switch out a light bulb or something like that, then the misuse of that product would be a valid defense that the manufacturer would have on that. The next type of liability we're going to talk about is vicarious liability. This is where the insured is responsible for the actions of the wrongdoer but didn't do it themselves, right? So the most common situation would be a parent would be responsible for the actions of their children. You would also have employers being responsible for the acts of the employees while they're on their job. Or general contractors for somebody that is doing a subcontract on their work site, right? Understand that the most common misconception here is that the owned animals would be vicarious liability. Understand that that is a direct liability, not vicarious. And then the last section for types of liabilities here is going to be contractual. Things like hold harmless agreements and waivers of subrogation. If any of you have ever been to one of those axe throwing bars where you take hatchets or, actually sometimes full-on axes and you throw them down on a block of wood about 20 feet away, right? This is a pretty dangerous type of situation. These companies would not be able to operate at all if they did not have these waivers of subrogation or hold harmless agreements, right? And have those pre-approved, of course, ahead of time by their insurer, right? So that they know that these are pretty ironclad and that the customer is going to be the one taking all the liability in these cases. All right. Next thing we're going to talk about here is damages. Another name for damages is going to be torts. Another name for torts is a civil lawsuit. Now, these things will come up anytime that there's an aggrieved party. The civil suits are brought by what we call against the wrongdoers, which are called tortfeasors. And these are going to not cover typically crimes or most intentional acts, right? And this is to recompense the aggrieved party for typically bodily injury or property damage in these cases, right? Now, there's two different types of damages that would occur. There's compensatory and punitive damages. Compensatory damages are going to make whole or indemnify the aggrieved party, and they have two different types of compensatory damages. There's going to be special. Now, special compensatory damages are going to be specific measurable damages for any out-of-pocket, for monies out-of-pocket for property damage, medical expenses, miscellaneous expenses, loss of wages. These are very typically easily calculable. There's going to be sometimes some dispute about the exact valuation of certain things, but for the most part, this is very straightforward as far as the amount. The second type of compensatory damage is going to be general damages, right? So this is going to be for compensation for things that are a little bit more subjective, like pain and suffering, mental anguish, disfigurement, similar types of losses. Judges and juries in these cases will have highly subjective determinations for the amounts on these things. And so, unfortunately, this is the area that is the most of a wild card whenever a lawsuit goes into place. And then the last type of damages are going to be what we call punitive damages. Now, insurance typically does not cover these because they're designed to be a punishment for extreme outrageous behavior, gross negligence, or willful intent. Now, under insurance policies, you can usually get policies that are going to be considered to be blanket or specific coverage. Blanket coverage is going to cover multiple classes of property at one location or multiple locations. You're also going to have the ability to buy a specific policy that covers one specific class of property at a specific location. Vacancy. Vacancy under insurance is defined as the insured structure with no people or personal property for 60 or more consecutive days. It's very important in the property insurance to understand whether the property is considered vacant or not, because certain perils are going to be what we call suspended or not covered if this condition is met. Similar to vacancy, but a little bit different, is going to be what we call unoccupancy, right? This is going to be an insured structure with no people, right, for 60 or more consecutive days. In this case, the personal property is not considered or there is personal property there. In the unoccupancy case, no policies will suspend perils if the policy is just unoccupied. Now, one thing that's kind of cool here is if you just didn't take everything in the world with you and you went on a year-long trip around the world, your insurance would still cover you for all the different covered perils in the case of that, because that would be considered an unoccupancy. Now, if you had literally taken everything with you, or maybe you're getting ready to sell the property or possibly rent it out, but you don't have anybody there, nothing, no people, no things. Once it's been vacant for 60 days, unfortunately, that's when those perils could be suspended. Now, a couple of different types of definitions that we got to go over here on theft. Theft is going to be any unlawful act of taking. It's going to include the other crimes that are going to be things like burglary, safe burglary, robbery, forgery, and other crimes. Right? So the theft is the overall large definition. Burglary is going to be defined as the crime of forced entry into or out of a premise. But for insurance to cover burglary, visible evidence of this forcible entry or exit has to be required. For robbery, this is the crime of taking or attempting to take property by force or threat of force from somebody else. Right? Now, the actual weapon does not need to be seen in this case. There doesn't actually have to be a weapon in this case. Right? So just understand that that's going to be the case with robbery. Mysterious disappearance. Right? So this is a situation in which there is no potential of knowledge as to when, where, the location, time, or how the property was lost. So losses by mysterious disappearance are typically excluded from most insurance policies, right? Open perils policies typically will cover these, but by definition, mysterious disappearance is not theft. So therefore, that's the end of chapter 2, right? And so now we're going to go over a little bit of a review. I'm going to go ahead and go over the different questions here, and we're going to go get the answers for these. So the first question here is, what is a hazard on page 39? Is it A, something that increases the chance of a loss, B, the cause of a loss, C, the loss event, or D, the uncertainty of a loss? So in this case, this is going to be A, something that increases the chance of a loss. Number 2, which is not an example of a insurable interest, right? So they're saying 3 of these probably will be an example of insurable interest and 1 will not, right? A is your interest in a financed car. B, a renter's interest in a porch he added to his rented home. C, a repair shop interest in a customer's TV which has been repaired but has not yet been picked up. Or D, your interest in your dad's rifle that he's going to give you when he dies. In this case, D is not an example of insurable interest and is the correct answer here. Your dad is the one that has the insurable interest at that time, but since he has not given it to you, there is no insurable interest for you. So if you had a policy on your dad's rifle, it would not be able to pay out. Number 3, what is the cause of the loss? Is this A, a risk, B, a hazard, C, a peril, or D, an event? In this case, this is going to be C, a peril. Number 4, a court awarded actual medical costs and an amount to punish the company. Which are the terms that best describe these awards? Is this going to be A, special and general damages, B, special and punitive damages, C, general and specific damages, or D, punitive and blanket damages? So the correct terms that match up with actual medical costs and an amount to punish the company is going to be special and punitive damages, option B. Number 5, a sudden and unexpected event that causes a loss is going to be described as what? An accident, A, B, a liability, C, negligence, or D, an occurrence. In this case, number 5 is going to be A, an accident, right? Now, understand that an occurrence is also going to be an accident, so it is a broader definition here, but because you don't see the words continuous and repeated exposure here, it is not referring to an occurrence. Number 6, which of the following is not a direct loss? Right, so 3 of these should be examples of a direct loss, and the other one should not. A, a couch is damaged by a fire. B, the insureds have to rent a room after a fire damages their house. C, hail breaks through a window. Or D, a deer damages the wall of a shed. So in this case, the indirect loss, or the example that is not a direct loss, in which the answer is going to be B, the insured is having to rent a room after the fire damages their house. In this case, the fire damaging the house would be a direct loss, and the need to get a alternate living space would be the indirect loss. Number 7, a dwelling is considered vacant after how many days without having a person or personal property in it? A, 30, B, 45, C, 60, or D, 90. In this case, it's just a memorization. Vacancy is occurring after 60 days with neither personal property nor people in the property. Number 8, which of the following is considered to be a bodily injury? Would it be A, sickness, B, physical injury, C, death, or D, all of the above? Well, in this case, there's more than one correct answer, but the most correct answer is going to be D, all of the above, because all of those represent a bodily injury. Number 9, which of the following is not an element of negligence? A, proximate cause, B, harm has occurred, C, an intentional act, or D, owing a duty. So in this case, intentional acts and most crimes are not going to be considered negligence. So C is not an example or an element of negligence. And then number 10, which of the following is true of liability policies? A, they pay on behalf of the insured. B, they only pay when the insured is proven negligent in court. C, they pay on behalf of the insured and defend the insured against real and alleged claims. And D, they defend the insured against real and alleged claims, pay on behalf of the insured, and pay only when the insured is proven negligent in court. Well, the answer here is actually going to be C. They pay on behalf of the insured and defend the insured against real and alleged claims. The answer D goes a little bit too far because you do not have to be proven negligent in court, right? Remember, you can admit to it or the insurance company may find you at fault, right? So in this case, C is the most correct answer of a true statement about liability policies. So that ends our introductory section along with the insurance terms, chapter 2. We'll see you here on the next section, sections 3 and 4. Common policy provisions under chapter 3, and the chapter 4 is going to be on contract law provisions.